We all would have cribbed sometime that we do not have enough capital to make use of this bull run and generate profit like the big investors. Today I am going to tell you how to make your capital work 4x and also generate profit 4x just like the big investors. Imagine you are a farmer who grows tomatoes and you are a bit concerned about the uncertainty of tomato prices because we have seen it skyrocketing to 200 per kg and then falling so bad at 5 per kg or 10 per kg. So you want to make sure you get a fair price for your tomatoes when you are ready to sell them. You find a buyer, perhaps a supermarket in your town, who agrees to buy 1000 kg of your tomatoes at a set price. You both agree on a predetermined price for your tomatoes, say 40 rupees per kg. That is something that you want to deliver within 25th Jan 2024. There could be two scenarios. Scenario number one, market price increases. The market price for the tomatoes goes up to 50 per kg. Because you locked in the future contract at 40 rupees, you sell your tomatoes to the buyer at the agreed upon lower price, thus avoiding potential losses due to the price increase. Here the buyer benefits 10 rupees per kg because buyer got into the contract for 40 rupees. The second scenario is when the market price decreases. So say it drops below 20 rupees per kg, you still sell your tomatoes to the buyer at the agreed upon 40 rupees per kg, despite the market price being so low. In this case, the buyer pays more than the current price, but you are protected from the lower market rate by the futures contract. So you benefit 20 rupees here. What we just saw now is called futures trading. A futures contract is a way for you as a farmer to manage the risk of fluctuating prices. It provides you with a guaranteed price for your tomatoes, offering a level of financial security. We also saw both scenarios when there was a potential profit you were still missing at one point in time, and there could be potential losses you are still escaping from the losses. So for instance, when you have entered into the contract for 40 rupees, the price goes to 100, 60 would be your potential profit that you are missing, and vice versa. When it comes to 10 rupees, 30 rupees could be your good profit that you are kind of reaping by entering into this contract. So it's a tool for managing risk in the face of uncertain future prices. There are several ways we can make our capital work 4x, and the number one way to make it work is using futures. So some of the examples that I'm using, I'm quoting some prices of stocks. Those are only for example purposes because by the time I'm taking this video and releasing, prices would have changed. Having understood the basic background of futures trading, let's get now into a real stock market example. Infosys is currently trading at a spot price, say 1500. You believe Infosys share price will go beyond 1600 in about 40 to 50 days. So by end of Jan 24, assessing the market trend, fundamental and technical analysis, you decide that Infosys is a very potential stock. If you want to buy 400 shares of Infosys at this spot price, it would cost you about 6 lakhs rupees. But you have only 1.5 lakh. What would you do? This is where the futures and options or derivatives come handy here to leverage. So you can really buy January Infosys futures contract, which is about 1,06,000, including brokerage, exchange transaction charges, tax, stamp duty, etc. So since the lot size is 400, for just 1,06,000 you can buy a contract, but with some terms. I have taken snapshots from Zerodha for easy access and explanation. So if you see, Infosys has 3 months like current month and future 2 months of future contracts, and all of them are available at a premium, meaning they are more than the current spot price. And if you look at the margin required is about 1,06,000 plus, and the charges are little higher when you are selling, meaning there are two ways you can enter into the future contract. One is going long, that is when you buy and then sell, and another one is going short. In that case, you are first selling and then you are buying. So with this method, you will be able to, with just 1.5 lakh or less than 1.5 lakh capital, you will be able to buy 4x required number of shares. Assume that we buy 100 shares of Infosys at cash. Obviously, we will be putting all the 1.5 lakh capital, and imagine if the price goes to 1,600 by end of Jan. So we will have a profit of 10,000 for 100 quantity. Whereas with the same capital or even less than the capital, when we enter the future contract with all the premium like 1,500 spot price being the future price will be 1510 because it's available at premium. So similarly, when it goes to 1,600 by end of Jan, 1,610 would be the future price. So by the time we close it, for 400 lot size, we will be achieving 4x profit in future contract. The flip side of the future contract is the loss will also be 4x. So in our example, we saw that 10,000 and 40,000 profit when the price goes up by 100. And same thing if it reverses, like the Infosys spot price comes to 1,400, then obviously if we book cash delivery, we will be booking loss of 10,000. And we have to close the trade by end of Jan for future, as the expiry date or before the expiry date we have to close. So when we close, if the price is like 1410, the loss will be 40,000. So generally in real time, the future contract traders do not wait until the expiry date. They mostly book profits early and move on to the next trade. So imagine if you have entered Jan and if you have got 40,000 profit even before the expiry date, you can probably book the profit and buy the next month contract. So it's also important to ensure that you put stop loss because as I mentioned, the risks are very high. If it reverses, you should not be waiting until it crashes to 1400. Rather, if you find out the trend and market trend, or even if there is any other issues because of that, if the market goes against you, you should exit quickly for capital protection. Apart from going long and shorting of positions in future contracts, there is something called hedging. So hedging involves using future contracts to offset potential losses in an existing investment. It's a risk management strategy. Suppose you own a portfolio of Infosys stocks and you are concerned about a potential market downturn. To hedge against the decline in Infosys stock prices, you can sell the Infosys futures contracts. If the stock prices fall, the gains from the short future position can offset the losses in your stock portfolio. So be mindful, the lot size should exactly match to your current holding size, that is 400 lot. So the outcome would be like if Infosys prices fall, the losses in your stock portfolio are partially offset by gains in the short futures position. And if Infosys prices rise, you may incur losses on the short future position, but your stock portfolio will gain. There's another strategy called calendar spread, and also it's called time spread, involving in taking positions in opposite directions, like you buy the Jan expiry date but sell the February expiry date. If Infosys price remains relatively stable, the gains from the longer term future contracts may offset the losses from the shorter term contracts. Again, you need to be very careful how to plan this and execute this. You need time to monitor this on a regular basis. Of course, you will have at least a month time to watch this and do. These strategies represent only a few examples and there are many more. and some involving combinations of options and futures contract. We'll see more in our future videos. Thanks for watching. Please like the video if this is useful. Please share your feedback.